Okay, the monetary policy checklist, Mark. And look, I think I'll start at the end again. Rates are on hold when the RBA meet next week. So GDP, we had it from the Bureau of Statistics that quarter-on-quarter growth was 0.4% for two straight quarters, 2.1% in annual terms. That's a little below trend, but it had to slow down. It's what the RBA wanted to see, so they'll be happy about that.
So just to clarify, for the last two quarters, what has been the growth again?
0.4, 0.4, two consecutive quarters.
So like if you extrapolated and said nothing changes for the year, we've got less than a 1% GDP growth.
We've got it slowing to 1.5 or thereabouts. Yeah. That's low, but remember it was very high post-pandemic. Yep. So it's sort of what we had to happen. If we're sitting here in 6 months and it's still coming in at 1.5%, that'll be in the easing column.
Right.
It's sort of the adjustment we had to have.
Yep. I think
Slowdown we had to have, not the recession we had to have, I hope. Inflation, look, I'm putting that still in neutral to tightening. It's come down. The big discussion we had on commodity prices will put a bit of a floor under the CPI. Not that it's going to change monetary policy thinking all that much, but it'll still have that elevated level because of oil. Yeah. Even though non-oil inflation is continuing to fall, not only here in Australia, but around the world.
But what you're saying, Steve, is that it's not going to allow them to reduce interest rates.
No.
But it's also not going to, it's not, they'll excise it out of the decision-making in terms of whether they should put it up or not, put interest rates up or not.
Yes. Yes, we're not anywhere near a rate cutting cycle, I don't think yet. Yeah. And I think that's important for us to talk about that. Yeah, just because rates are not going up, it doesn't mean they're coming down.
Okay, just the last two quarters, though, what have been the last two quarters of
Last 2 quarters for the CPI, well, the last one was a 0.8.
Yep.
Which was the lowest in about 3 years because we had lots of 1.2s and 1.3s. So the 0.8 was actually, and if you annualise that, that's 3.2. So just above the top end of the target range. Yep. We get the next official CPI at the end of October. So we'll hopefully be able to talk about that next time.
That's the next quarterly.
The quarterly one, but the monthly numbers have gone down below 5%. So all the figures 5%. Are the 4.9 we had below 5. 4.9 was the monthly annual CPI.
Yep.
So we've got it going in the right direction, but to get it to an easing, it needs to be well and truly in the 2 to 3% range, probably at the bottom end of that range, and we need some of these other things to be turning as well.
Okay, right up.
Labour market. Well, one thing that we had last month in terms of the labour market numbers was confirmation of unemployment at 3.7. We had a big jump in employment, but there's, a school holiday effect, according to the Bureau of Stats. So I'm putting that in neutral. I like low unemployment, so does the RBA, but it's stopped falling and it's creeping higher.
The question remains, though, is what is low unemployment?
Yep.
Last time we met, we went through the non-accelerating inflation rate of unemployment, NAIRU, which they're talking about 4.5%. The RBA would like to see it or have modelled it at 4.5% at some stage. So, at 3.7, that might be considered to be hyper unemployment. It's hyper low in unemployment.
It's very low still, but when we look at things like job vacancies, they're trending down.
Yeah.
And in fact, there's a very nice chart. I can't remember who did it. One of my so many emails I get that showed the correlation between, I think it was the SEEK measure of job advertisements, the SEEK, the labour hire company, and unemployment rate with a 6-month lag, because the labour market's like the old oil tanker. It takes a long time to turn around. But in 6 months' time, they're forecasting a 4% plus unemployment rate, if that correlation holds.
Yep.
Now, that's softening the labour market, showing up in wages. We had wages numbers, again, 0.8.
We're talking about wages growth index.
Wage growth index, 0.8% quarter on quarter, 3.6 annual. Beautiful. It actually ticked down a little bit. And yes, if you sort of waved your magic wand or your Goldilocks, not too hot, not too cold, just right. Happy, neutral, don't do anything. International economy, I'm going to put that more in neutral. I think last time I had it verging on easing, but the numbers just in the last month have been a little bit better than expected in the US. China seemingly has come through its weakness a little bit better. Things like commodity prices, which I'll touch on in a minute. In fact, I'll go to that now. I know it's not in order, but commodity prices have actually kicked higher. I'm going to put that in the neutral column as well, and that's because the global economy, the international economy, is a little better than most people were thinking. So those two things are well and truly in the neutral. You don't cut because of them, you don't hike because of them, but there's just this sort of interplay of forces going on right now. House prices still going up, the core logic numbers. Here we are, September's probably going to be another month-on-month increase close to 1% Australia-wide. Sydney's stronger. Brisbane's pretty strong. Melbourne's going up, but pretty weak at the minute. But you put house prices in neutral. The RBA is not worried about them yet, either up nor down. So we're getting a run of information in the middle here. Retail sales. Shocking, weak. We're touching on that retail spending number, and while a few of the oldies are spending more money, that big cohort of renters, people with a mortgage, people with real wages falling, they're hunkering down. So retail sales numbers are drifting lower, and they have been for 6 or 7 months now. That's consumer sentiment interlinked. Consumers are feeling gloomy. Not just $2.20 a litre petrol and all these other things. Real wages, even though inflation's coming down and wages are going up, we haven't had the crossover yet.
So who's doing the surveys there? Consumer sentiment?
It's the Westpac Index of Consumer Sentiment.
And NAB?
NAB do business confidence.
Right. That's next.
Which is down here. I'll go to business confidence. It's actually good.
Yeah.
And this is this strange, I'll put it in neutral because you don't want to crush business confidence. One of the things that came through the GDP numbers, because GDP is made up of consumption plus investment plus government plus exports minus imports. You remember that accounting mechanism from Eco 101?
Yeah, well, that's
I roughly remember that.
That's the expenditure method.
Correct. Yep. The expenditure method of GDP. The investment, the investment, private sector investment was up 11% year on year.
But it's also based on
businesses doing well.
It's also we should just tell everybody, business investment is non-mining. So in terms of, can you just give us a quick breakdown of the two?
Well, actually, mining's doing okay because of the high commodity prices. But it's not the funny thing. The interesting thing is that there's a lot of non-mining capex, and when you dig beneath what our businesses investing their money in, there's a lot of machinery and equipment. A lot of IT stuff, of course, just to keep up with the ever-changing technology in the world. Firms have to ramp up their IT spending. So that's one of the things. The way we're changing our expenditure means that things like warehousing and logistics buildings, so the building, non-residential building construction in that area is strong. Hotels, also very strong. Now, office towers, weak. But bottom line, you add up all these components of what businesses spend on machinery, equipment, buildings, it's pretty good. So I'm happy with that, and business confidence is good.
We might as well move business investment then, Steve.
And business investment, well, I wouldn't put it into hiking, but again, it's a good thing. One of the things that we've had for a while is the poor productivity. One of the reasons why Australia's had poor productivity, we haven't had enough capex. I'm reminded of an analogy. I use this one occasionally. If you're a mining company, you have 100 blokes, a shovel and a wheelbarrow. Go and dig out some iron ore. At the end of the day, you'll have a bit of iron ore. You spend $1 million on a big digger with one person operating that machinery, you'll dig out probably 100 times as much iron ore for one person. Your productivity is enhanced because you've invested in a digger. So that's how productivity comes through business investment. Building approvals, shockingly weak. We're not building enough houses. I know the government's got that plan to build 1.2 million dwellings in 5 years. I wish them luck.
The general view is they won't do it.
Bloody hard to achieve. Look, as I sit here now, if I'm a betting man, I'd say they won't achieve the 1.2 million. Now, have an objective, and if they can get state and local governments to ramp up and speed up their approvals process, the land rezoning issues, they might get close. But gee, the cost of materials is still relatively high. Even though the unemployment rate's creeping up a little bit, we've still got a relative shortage of tradies, the bricklayers and plumbers and sparkies that you need to build a house. So the building approvals are still really weak. Stock market's edged lower. I'm going to put that in neutral. It's choppy. The Fed going to hike? Are they going to cut? We've had the bond yield selling off, and that's impacted negatively on stocks, but I'm going to leave that in neutral. Current interest rates, going to move slightly easing because they are restrictive. And even Dr. Lowe, on his exit speech, said that interest rates are restrictive. And if the RBA say they're restrictive, they are restrictive. They don't understate this sort of thing. So when we look at this overall picture,
it tells me we're not going to put rates up.
We're not going to go put rates up. Now, again, as we've said every time we discuss this, the items at the top have a much heavier weighting than the items at the bottom. So GDP growth, inflation, the labour market and wages, they're really important. These are not unimportant, but they don't have as much oomph. in the decision as these top view. And as you can see, they're only neutral or a slight tightening bias. So overall, when the RBA sits down to have a think about interest rates, it'll be on hold, and I dare say the statement they put out will cover a lot of this.